Mark, very good to see you. The Dow and the S&P hit new record highs, but how long will this rally last? The S&P 500 recently crossed above its January 2022 peak, fueled by investor optimism and signaling from the Fed that we will begin to see lower interest rates. In the third quarter of 2023, the market experienced a record downturn. So now we're seeing these record highs. What's going on?
Well, we got quite a rally off of essentially news not being as bad as expected. And
Mhm.
so that was in 2023 as the market started to rally back from lows hit in 2022. And then the news just kept getting better and better. And the jobs market continued to be really resilient. So unemployment is very low relative to history. And this has allowed the consumer to continue being very strong and surprising on the upside. So I think there's been a lot of good news that keeps surprising the market and the overall economy.
hmm So let's talk about this good news. Drill down into consumer sentiment, which surged 29% since November, the biggest 2 month increase since 1991. Are investors finally starting to believe what the experts have been saying for a while, that the economy is actually doing well?
Definitely. And I think it really is because household net worth is at a new high as well. And so there's something that really started, probably before you were born, Aaron, in the late 1990s, where they started to explain the economy in the terms of, well, it's the wealth effect. And it just kept perpetuating on itself. The consumer remained strong, markets remained really robust as the market continued to rally in the late 90s and talk about irrational exuberance and so forth and the excitement around that. But really, it was the consumer that remained strong, and it was because household net worth kept moving higher, and that's a combination, of course, of your house value and then also your investment value, whether that's the 401k, the retirement plan, your investment account, and so forth and so on. That allowed consumers to stay pretty positive and spending to continue.
hmm So the Dow also reaching a new high. So this is when we all feel like we should be jumping into the market, right? But this doesn't that also signal that we are reaching the point of maximum financial risk on this investing cycle of emotions? Or do you feel like there's still more room for this rally to run?
Yeah, sentiment is a contrary indicator, and it's one of the more prescient indicators, I think, in the marketplace to gauge risk, just as you're alluding to. Whereas on this chart on the right-hand side, you have the point of maximum financial opportunity. We really saw that at the end of 2022, where everyone was predicting recession first
hmm
thing into 2023. But that was when the market was really oversold. And that's when the opportunity presented itself, and the market just started to climb this wall of worry back. And now we have had a pretty good run here, touching new highs. And I would say when we look at the data, the underlying data, though, it's really been concentrated in a few stocks. So it hasn't been the broad market that's ultimately participated or the average stock necessarily. It's really been led by these mega cap stocks. And so
hmm
underneath the surface, you'd say, well, the market's a little bit out of gear. So we would start to raise a little bit of the caution flag as we head out into the spring here. Remember, it's an election year. So we're going to have a lot of headline driven market reaction when we get into 2Q and 3Q. So we're definitely not complacent at this point. We think maybe 1 to 3 month equities can continue this momentum until it kind of runs itself out. But then we've got to think about a phase transition where we'll be a really headline-driven market.
hmm
Some concerns will start to pop out in 2Q and 3Q that we're definitely aware of that can transition. So I wouldn't get out over our skis at this point. Anywhere where we're overweight equities, we would take it back definitely to where we'd call it market weight, and then maybe into May even think about underweighting. But that's an idea, and that's just good risk management.
Okay. So I'm glad you brought up recession because that is, of course, my next question. The Fed has been working really hard to navigate that soft landing. Do you think that we will see a recession in 2024?
So one of the interesting parts about 2024 is that good news might be bad news in the sense that, well, if the job market stays strong, the Fed is going to be concerned about reigniting inflation. And so they'll have to keep short-term rates elevated and not be able to reduce short-term rates. And at the same time, we have a slowing China, very quick in China, which is creating some deflationary pressures in the goods market that's going to spill over into the US, meaning that inflation is actually has a good chance at coming in below expectations faster and lower than the market expects. And that would leave the Fed in a bind where they'd say, well, now interest rates on the short end are too high and we're causing
Mm.
really tightening conditions. And that could cause a recession. But it continues to be delayed, and it would be at the earliest probably the back half of 2024 into 2025. But I wouldn't say it would be a strong one at this point unless we had some further evidence. So that would not be our base case going into 2024, but it is a risk later in 2024 or late
Okay.
2024 to
Okay.
be mindful of.
Interesting. Are there any other risks or opportunities that you think are going to present in 2024?
Yeah, definitely. I think small cap stocks have underperformed significantly. In fact, they were down on the year and they're about 20% off their highs, where the large caps are making new highs and so forth. And so that seems to be maybe a low risk entry point here out if we look at over the intermediate term. It's hard to compete with the Magnificent Seven stocks that are kind of taking all the attention, all the capital at the moment, but that does transition. And right around here would be an area that you start to think about that idea. Another one would be, well, if we think inflation's coming down quicker than expected, well, now you can look at longer term bonds, because then you kind of
Mm.
defend against two risks. One, if you are concerned about a recession, and then the Fed would be reducing rates, longer term bonds seem like a decent proposition here. And that's not a forever trade. We wouldn't want to lock capital up, but we're talking about opportunities here that we see over the intermediate term where interest rates could come down, which means bond prices rise. And you could see definite environment where bonds start to outperform stocks for a couple of quarters. So that's an interesting one. And another one outside of the box, there's something to add a dimension of an interesting dimension to the portfolio, is that the yen, the Japanese yen, is about 40% below its purchasing power parity, which seems to me quite an extreme, where we could definitely see, if the Fed is starting to reduce rates at some point later this year, the US dollar start to anticipate that and decline a little bit, and the yen would be in a logical place to
Hmm.
maybe see some appreciation, and that would add a different dimension of risk and return to the portfolio. So that's kind of an interesting area of opportunity from a portfolio construction perspective.
It is. This was great, Mark. I always enjoy diving into the headlines with you. Thank you so much for your time today.
Great. Thanks, Aaron.